Don't put 20% down on a home without watching this first. So let's do some math. On a $500,000 property with 5% down using today's interest rates, taxes, insurance, and PMI, you're looking at a total payment of around $31.29. This is as long as you have really good credit. Now on that same $500,000 purchase, if you were to put 20% down, your payment with taxes and insurance using today's rates is estimated to be about $25.63 a month. That's a difference of about $565 a month, but it's also about $75,000 more out of pocket. So it'll save you $565, but it's also going to cost you $75,000 more cash now. Now, what you got to consider is if you have any debt that has an interest rate higher than the mortgage you're about to take out, you're much better off putting less money down and paying off that higher interest debt. On average, let's say you did have $75,000 worth of debt between student loans, car loans, credit cards, whatever the mix may be. That's going to result in minimum payments of around $1,000 to over $3,000 a month, just depending on the interest rates and the debt mix. So instead of paying off high interest debt and putting all that money into your mortgage, it's really costing you more in the long run. Now, the rich get richer by leveraging every dollar and being smart with it. They leverage good debt to pay off bad debt, or they use that money to go make much, much more than the 3 to 4% that money that they're leveraging is costing them. Look, at the end of the day, your mortgage payment still needs to be affordable no matter what. So whether you have to put 5% down, 10% down, or 20% down to make that happen, that's the way to go. However, you should always do the math to make sure putting 20% down is really going to be the best thing for you and the best use of your money.